welcome. Welcome to what's been our home for us as Deloitte leaders in the room. This has been our home all week. It's been fantastic. This environment here has been so conducive to good conversation. We've had so many different conversations. And I'm really proud, actually, to be talking about this topic today, the guiding principles over the governance of climate and nature, because this has really been a culmination of a long-standing relationship between the Forum, Deloitte and the Chapter Zero Alliance. And we're really proud, actually, of the work. And I'm excited that the team are going to be sharing with you some of the highlights, and we're going to get into a good conversation about the practical use of this. Because let's be under no illusion, life is really complicated right now. The world is complicated. And for us as business leaders, with things changing so quickly, with that level and degree of uncertainty, it's quite distracting for us because we're pulled into the today all too often. And that's taking our focus away from the longer term resilience of our organisation, which is really what we're there to do, to lead our organisations to future success and future positive impact for the business and for the communities and societies in which we all live and serve and work. And so it's really timely when you look at some of these guiding principles that we're going to be talking about today, because as a board chair myself, and I'm the chair of our global board for Deloitte, the agenda's really full. And we keep getting distracted to what's happening today and the decisions that are making today, or yesterday, maybe. We know that as a board, we're there to enhance and enable the success of our organisations and protect its resilience into the future. And therefore, we need to play that balance. And it's quite hard sometimes, I think, as a board chair. Nobody tells you how. You don't quite make it up on the spot, but you are thinking and you're talking and you're comparing notes. And I think what these principles do is give us some really practical guidance as to some of the things we should be talking about and thinking about. So we're going to have a great conversation. Before we kick off, Pim Valdre, who leads on climate and nature for the World Economic Forum, we're really pleased we've worked together for such a long time between Deloitte and yourself. So you're going to come and share some insights into the principles.
Thank you so much, Anna. I think I have a mic, so it's fine. I'll stand up. And it's a really delightful opportunity to be here to represent the World Economic Forum. And I just want to start by thanking Anna and Deloitte and also Chapter Zero Alliance for this collaboration. This is not a new topic for the World Economic Forum. Actually, back in 2019, we launched the predecessor to these principles that we're launching today, the Principles for Effective Climate Governance. And since then, we've been working with the Climate Governance Initiative and through their chapters with local NEDs, with local chairs and board members to see how can we more effectively integrate climate into board decision and strategy. And I'm really excited today to launch the new edition of this. And what is new? I think Anna already touched upon this, but I would say there are three things that are new and that are sort of the reason for why we're launching this new framework. Anna already touched on the short-term disruption. I think that has been very present this week in Davos. I would almost call it's an era of extreme short-termism. And that sharpens the challenge for climate and nature, because these are long-term structural changes that have, real repercussions for the balance sheet, for the resiliency, not only of climate and nature systems, but of our businesses, right, of our business model. So that's one thing. The second is nature has entered the scene in a huge way, right? We had the Paris moment for nature with the Kunming-Montreal CBD framework in 2022. The challenge now is how do we take this framework and integrate it and translate it into economic frameworks that make sense for business, right? And I think these principles will do a really good job in that. And we also have and will develop sector-specific guidance on nature, because we know that this is quite tricky for boards to navigate. And I would say that the third is the growth opportunity. I was just yesterday with the Alliance of CEO Climate Leaders, which is another community that I lead, 130 companies across 12 sectors, 27 countries with a combined revenue of $4 trillion. We launched our annual report looking at the green economy. The green economy stands today at $5 trillion. It's projected to increase to $7 trillion in 2030. It's a huge growth engine for the global economy. And this is also the opportunity that we want these principles to enable boards to capitalize on. So over the past months, we've, together with Chapter Zero Alliance, engaged with over 70 board members to develop this framework. I have a little slide here. You also have on your chairs a summary of these principles. But essentially, we deliberately simplified this framework. So we moved from 8 principles to 4, which are underpinned by 3 foundational concepts. And the aim here is not to dilute ambition, but to sharpen the focus and the usability for boards. So we have 4 principles. The first one is oversight and responsibility, starting from a clear and uncontroversial premise. Boards are accountable, climate and nature governance cannot be delegated away. Strategy, which I think is one of the more sort of challenging issues that boards navigate. So in recognition that climate and nature are not compliance issues, they are core strategic board level issues that shape future business models. Risks and opportunity, right? We enter with the risk framework, but we stay because of the opportunity. So there's also a lot on the opportunity here in this framework, and disclosure and transparency. So mandatory climate reporting is as relevant to directors as it is to investors. So we're also seeing, of course, nature-related disclosures coming in a big way. So we've included quite a lot on this. And then we have the 3 foundations, or the levers that will make this work. And those are the right skills and knowledge at the board level. They're also stakeholder collaboration, so not just engagement, but actually ecosystem collaboration with some of the key players that will make this transition move ahead. And the right culture, one that enables challenge, long-term thinking, and informed decision-making. So we really hope that these principles will come to great use to many of you here today. And I just again want to thank Deloitte for this excellent collaboration, and also Emily for our collaboration with the Chapter Zero Alliance. Thank you.
Thanks, Paul. I love the fact that actually we've got you now branded in the pure Deloitte green, which is fantastic. I love that. I have to borrow that another time. Look, I personally think these principles are fantastic because of the practical nature, as you've said, and in all the discussions that we have as a firm with chairs of boards of our clients or leaders in our client base, there's no doubt that this topic now is no longer being seen increasingly as something that one does on the side. And from a board perspective, you know, we would have a climate committee or whatever off the side. This is now a core strategic priority, which is more and more being recognised as something that will drive business value. So it's on that note, it's with great pleasure that we have Paul Polman with us today, who's going to be quizzed on his perspectives. Paul, can I welcome you to the stage? It's great to see you again. It's really hard to know how best to introduce Paul because everybody already knows who Paul is, and to spare your blushes, I think many of us see you as a pioneer in many ways in what you did as CEO, as Unilever, embedding purpose, climate, nature in a very different way than we'd seen before. What you have achieved since then in all of the activities and the organisations that you've led, the thought pieces in the book that you've written, it really has been quite an inspiration around how to think about some of these things. So we're really grateful that you're with us. Thank you very much. I've got a few questions here. I'm going to put my glasses on to ask them. So this conversation today is very much around boards and boards' responsibilities. And if we do go back to that time as CEO of Unilever, which probably feels a long time ago now, and life and the world has changed so much since then. There was some new, pretty much groundbreaking type of thinking that you were putting into that organisation and what you were trying to achieve and how you were trying to connect with the consumer market at that time. How did that work? What was the most sort of valuable support or challenge that you received from the board? Your relationship with the board as CEO, chair, and board. How did that work to drive that forward?
Yeah, so this is incredibly important what you're doing here, and thanks to the partners as well, without repeating, and putting out something that I read now twice, and I'm ready to send it to at least the 5 boards that I'm on and many other friends I'm working with, because the strength is actually in the questions you're asking, and many people struggle with that. Now there is a knowledge gap that is tremendous as well that we need to address, otherwise you can't understand the answers to the questions you're asking. So that's important as well. But when I came to Unilever at the end of 2008, the situation was quite different than what it is today. So you have to take my comments in context a little bit, if I may be honest. But in 2008, I entered a company for the first time, bringing in a CEO from the outside, height of the financial crisis. Basically 10, 15 years of severe underperformance, which led to looking outside for someone. And so I had to change things, you know. So there's a fine line, as we all know, between courage and stupidity. And I don't know sometimes on which side of the line I was on. But I knew for sure that I had to change the way that that company was run. And everybody in the financial crisis, the first reaction for most of the CEOs, which you see now again, if I may be, is to hunker down and focus on cost savings and actually shrink the model of what drives value. I had no choice, you know. We'd gone from 55 billion as a company to 38 billion. We were in the business of selling our businesses. And, you know, I thought it's better to grow our businesses. So what one does is, I read a lot about the history of Unilever because I needed to get acceptance within the company. You know, you cannot be respected just because you're the CEO. You need to be respected because you're bringing value. And in my case, it was a little bit more challenging because I came from Nestle. I had worked for P&G. So it was a little bit, for some people, the Trojan horse comes in. For them, it was like a defeat a little bit. So I had to work double hard. So I took a page out of the book of Jim Collins, From Good to Great, where he talks about nurturing the core before you stimulate progress. And really go back to what are these things that made these companies great as they are and survive 150 years, which is very difficult in today's world, where the average length of a publicly traded company is only 17 years. And Lord Lever already created his company with a concept of shared prosperity. He already looked at multi-stakeholders. In fact, I'm not saying it's not important, but he didn't really care too much about the shareholder because he was the shareholder. And actually always ahead of the money he earned, you know. Was a strange guy, but he built houses for his workers before the factories were running. Or he guaranteed wages and jobs back when people volunteered for World War I. He's the one who introduced pensions in the UK. When he went to the House of Lords, he took the name of his wife. I mean, even today, nobody else has done it. It's kind of, you know. So he was really quite a different person, the way he thought about things. And this concept of shared prosperity was very important to me because it's very clear that value creation happens in most companies 5-10 years out, depending what businesses you're in. So if you want to create value, you have to run these companies for the longer term. Of course, you have to deliver for the short term. Never use it as an excuse, although I personally am not much of a fan of short term being 90 days. This whole quarterly thing is ridiculous. But anyway, you have to run the companies, but you run it for the long term, for that value creation. You have to do that with a strategy that differentiates you from your competitive set if you want to grow. So I thought this shared prosperity that he had, he called it at that time making hygiene commonplace. In Victorian Britain, 1 out of 2 babies didn't make it past year 1 either because of hygiene. So his mission, that's why he did the bar soaps, you know, the Sunlights or the Life Boys and all that, was really his mission was to attack the issues of hygiene. So his purpose was very strong. His vision was a longer term vision. And he had a multi-stakeholder model. So I thought these are enough elements to deal with, and at the same time bringing in some discipline because there's some normal things you need to do. So my first request, I didn't have many requests because I never liked to ask people things. I'd better focus on what needs to be done. But before I joined Unilever, I had 2 requests. They had historically always had 2 CEOs. And I said, you know, it really doesn't work anymore in today's world. So if I take that job, I really, given the changes that need to be made, I just want to be sure that we have 1 CEO. So we changed. And then the second thing is, I said I need a different board because we have a different strategy and it needs a different board. So I had in the first 6 months quite the opportunity. It gave me a little bit of a problem later on because I had to stage board succession. You know, so doing it all at once in hindsight might have been a little bit too much. But I got a board that actually, I started to think about who are the best people that actually can bring this strategy to life that I had thought about. So I put a board together that was diverse enough to challenge me, to understand a little bit the direction we were going. And that was the most important thing. Now, I had to do quite a lot of things in the first 12 months because life is too short. So I had to stop quarterly reporting to get the company to focus longer term. I had to say we are moving from a myopic shareholder focus model, which frankly hadn't worked, to a multi-stakeholder model. I came out with this Unilever sustainable living plan of decoupling our growth from environmental impact. Nobody has ever thought about that or said it at that time. There was no other company. And then I said, we're going to take responsibility of our total value chain. And the targets that we're setting are the targets that are in line with science. So science was already very clear on climate, less on nature. I think less people understood that. But it was very clear to me for a long time already. I'd been to Rio in '92, I'd been to Rio +20 in 2012. So I've always been interested in it. I was one of the first people to join the World Business Council. I chaired it for a long time. World Business Council for Sustainable Development. So I always felt that it's ridiculous that we have an economic system where we destroy that actually keeps us alive. And this is really what people are starting to understand now. And that never is a long-term strategy. So I wanted to be on the right side of history. So I wanted to create a business model that was regenerative, where you actually think about improving the state of the world. How can you profit from solving the world's problems, not creating the world's problems, which we have enough of? So it needed big targets that would make us feel uncomfortable. Then it needed trust. So I wanted to put these targets out in public. And it needed a responsibility over the total value chain. Even today, many companies still think they can outsource their value chain, and by doing so also outsource their responsibility. It just doesn't work anymore. So you can understand that the board was very uncomfortable. And then on top of that, when I sort of announced some of these things to the financial market that had no clue, that had never heard a company really talk about climate change or sustainable business models, the share price went down 8%. So which I felt very happy about, because it had gone up 8% when they announced me, literally, and then when I announced this plan, it went down 8%. And those were big swings. In today's market, you think that's sort of what we do every day now, but there were big swings in those days. So the board was nervous. The board didn't know either. We didn't have any benchmarks. We didn't have the technologies as much as we have today. And the knowledge of how do you create value in that system was not really there. So I spent a lot of time on enrolling the board in the same journey of learning that we had to go through ourselves. I said to the board, I don't know what I'm doing either, to be honest, because nobody has done it, but I just think it's the right thing to do. And if we hire the right smart people, then I think we can succeed. So the first year I changed about 75 of the top 100 people that were understanding the future direction that we were going to take. I put a sustainability board in place with the best people I could find. But I looked at all of the climate science, nature science, the circularity, and got these people around. And I said to our board, the most important thing is that our skill sets develop in line, because if we run too far ahead of you, you're going to hold us back, and we can't afford that. So I said, you're getting paid for being in the boards. We had 6 or 7 board meetings a year. But I said, every board meeting I will do a day before the learning sessions, and you are free to participate or not. The reality was always 100% attendance, and they would always participate. So this shared learning was a very important part of it, and that shared ownership of that new model. So even when the board then felt uncomfortable about some of the decisions, because despite these people being mission-driven, there were disagreements. There were 2 board members, not to be mentioned now, obviously, but they were adamantly against getting out of quarterly reporting. And they got pressure from quite some shareholders that were obviously the loudest shareholders, not the majority of shareholders, but the loudest shareholders that were pulling on them. And they were on boards of companies that were pretty short-term focused. At that time, I was on boards of publicly traded companies as well that are pretty short-term focused. So they felt their own reputation was at risk, which I think is the biggest risk of board members. We hire great people that have made great careers, often in the past that might not be relevant anymore to the future, but they are first loyal to their own reputation before they're loyal to your company. We would be naive to not understand that. So the risk profile of these board members is quite different. So I only asked them one thing, and I was fairly new, that was good about it, and they didn't want to lose me right away. But I said, we can disagree in the board meetings, and you decide ultimately if you don't want me to do it. But when we do it, I just want to be sure that we have a united board. So, agree, disagree, but commit. Yeah. So the shared learning, which was very important then, which is now much more readily available, the shared commitment are probably the most important things. And then I needed my board. For the third thing, I knew that this was not going to be a smooth line. That would be naive. That would be 6 months that would be good, 6 months that would be bad. Areas where you had to invest in the business and your profits might actually go down. I don't know if you could immediately get the growth back. So this was going to be a roller coaster, certainly for the first 3-4 months, years, sorry. So I needed the board's firm commitment that we would stay the course, that we didn't start to wiggle-waggle at the first sign of pressure. And that required probably the most attention, that we kept our spine. And if you now look at the numbers where we are today, this is not Unilever, but you look at the macro numbers, the information tells us that actually boards are spending more time on the short term than the long term, and short term is really short term. If you look at the requirements, there's the 10K in the US, and the 10K in the US requires you to report on risks. So we report, if you look at companies, they report on currency risks, they report on interest rate risks, they report on legal risks that they might have, but they don't report on nature-related risks or climate risks. I mean, I haven't seen any, very few. And yet these risks now are much higher than all the other risks that they report on. So for some reason, we have not been able yet to materialize that. And so why is that? I think there's still an enormous knowledge gap at boards. People don't keep boards up at the same speed as they develop their companies. So that is the one thing. Secondly, they are really not well versed in understanding how that translates into value creation, which is a very important thing. And thirdly is, how do you bring it into a company, into its values, into its purpose, into its culture?
And that's really insightful. And I think in this space, climate and nature space, there is this growing recognition actually that this is a driver for value creation.
It's very investable.
This is a driver for value creation. And you've touched on some really interesting pieces there around the board itself. Who should be on the board in terms of skills, attributes, capabilities? But that's not enough in itself. It's that education, and how do we engage with our individual board members that they take the responsibility as well. And it sounds like you were successful in achieving that, to encourage them to the learning journey.
Successful at that time. The standards have moved up quite rapidly.
Yes.
You know?
And I know in my board, and Jen's here, she's over there, you spent some time as our global sustainability leader leading our board in their education programme, which is really important for us to make sure, to your point, we're not lagging behind where our organisation is going. But even those things, you get into the boardroom and you need the right psychological safety to enable a good discussion and the dissent that you talked about. But also, any board is only as good as the questions it asks.
Absolutely.
So on that note, in terms of these guiding principles, what's your perspective on the value of having that guidance to enable us to ask the right question and to challenge us with ourselves whether we are, but also moving on from that, where and how do we ask those questions? So there's constant debate, and I have this conversation with many chairs around, do you have that conversation in the full boardroom? Climate used to be in a committee over here.
Yeah.
It now should be core into our broader strategies, touching on all parts of our business. How should that work, and how should the governance frameworks look around that?
Yeah, so I think the best boards are the boards that also have a good relationship where the CEO can be trusted instead of feeling that they're being inspected. Yeah. Many CEOs that I meet right now say that I have a problem with my boards. They don't think long term, they don't want to do the sustainability stuff if you want to. They don't understand what I'm trying to do for long-term value creation. It is like these boards talk about, having a divorce nearly, or being in the process of, and sort of not enjoying the next board meeting coming up. It's actually surprising to me how that works, and that would be a shame if that is how you run your companies. The leading companies, I think, that move forward and that are leaders on climate or leaders on nature, and we have enough of those companies who, by the way, also get rewarded now very clearly in higher value creation. I don't have to sit here anymore and explain to you that if you run your companies better, that you see more opportunities, that your people are more engaged, that you can hire better people, that you will become more innovative, that your partners in your value chain will give you the best ideas. So we can see already a clear bifurcation in the companies that are leading. Even amongst all the companies that are moving on climate change, the leaders in these groups are actually getting a higher value creation. So leaders amongst leaders. And so that's an average statistic. There are always exceptions, and the press or the opposition likes to pick these exceptions. But broadly, that is the case. You still need to, I re-stress that, you still need to run your companies well. If you hire the wrong people, have the wrong strategy, don't like discipline because you prefer loyalty above performance, all these things will hurt your business. But broadly, businesses that are internalizing these challenges are actually getting better valued in the marketplace. So if you have you need to figure out why your boards are there, not from a governance point of view, because we all understand that, what the roles of boards are, but how you can leverage the boards. I'm Dutch, so I'm quite stingy. So I said, these buggers get paid quite a lot of money. I need to get my money's worth. Otherwise, it doesn't work for me. So I put the board on the same performance system that I had in Unilever. I changed the performance system as well. But I said, you're going to be on the same performance system. We're not automatically being a board here for 9 years. Because you're telling me also, I'm not automatically a CEO for 10 years. I ended up being there 10 years. That was enough for me. But I wanted to do other things. But I said, it's not given that you just have that. In most boards, it's given. I've been on boards that people are there for 25 years. A quarter of people in the US on boards are 65 years or older. I mean, and I'm not going even to some of the statistics above that. So it's not a birthright, or once you're in, and then we're cozy. So I put that pressure in the board. But I then also said the rewards are being shared as well. I insisted that all the board members were paid in stock options. I actually encouraged the board to buy Unilever share, which did very well because in my 10 years they got a 300% shareholder return. But I made them part by keeping their independence. I wanted them to be independent enough to challenge us, but I wanted them to be united enough to support our strategies, because I knew that times would be good and times would be tough, and that's where the real tests are. So you have to invest in your boards in a different way. So I invited board members to my house with their families. I would spend a day with them and go out. I would invite them and come with me on a business trip. I would let them go out alone to see other people in their companies. Now, for board members to be comfortable to do their roles, you have to equip them. Because if they ask the questions, and this is very important work that you do, because the power is always in asking the right questions. And I think you're framing it very well. But you need to make them feel comfortable as well to have them ask these questions.
Yeah, very much so. That's hugely insightful. And actually, I recognise that piece around really investing one-to-one with your board members as a group, getting the confidence to ask those questions. Yeah. Sorry, Scott. We are going to broaden out the conversation. I'm going to switch seats and hand my seat over to Jen to continue the conversation with a wider group. So, Jen, over to you.
You need that?
I keep the mic. Okay. Terrific. I'll come sit over here.
Well, that was a great way to start this conversation today, and thank you, Pim, for setting it up. We really heard quite a bit around value creation, what you did, Paul, which leads very well into the next part of the conversation, where we're going to continue to focus on how we can implement some of the parts of the framework more effectively. So I'm really pleased that we have two other terrific panelists that are going to join us. Emily Farnworth, who is the CEO of Chapter Zero Alliance and Executive Director of the Climate Governance Initiative, so please join us. And Neely Gilbert, who's an independent director on the board of Brookfield Asset Management. Thank you and welcome to you both. So I'll give you a second to sit. Emily, we'll start with you. Given your role as CEO of Chapter Zero Alliance, we've been doing quite a bit of work with you for several years now, which we appreciate, on the subject of climate and nature. And I think, as Paul alluded, nature is a newer part of the conversation as well, so it's really great to bring it in. Can you briefly introduce Chapter Zero Alliance and your role there, and then talk a little bit about how you've seen the conversation evolve on boards, in particular now, and the approach around climate and nature over the last few years.
Sure. Thanks, Jen. And it's just delightful to be here. I might start by explaining why we exist, because that will help explain what we do. And Paul's just given such an incredible introduction to this. We know that board directors are facing so many challenges, and this is complicated. We are hearing every day how complicated the world is getting. Climate and nature are two of those very complex issues, but they're two of many, many issues. And board directors are needing to get up to speed with what this means for their business, for their market, for the new opportunities that are coming up. But we also know that board directors are trying to grapple with so much information that we need to be able to provide this in a succinct way. We need to be able to provide information on the risks and opportunities of the climate and nature aspects of a business model, if you like, or the future business models in a way that's meaningful. We also know that there is, again, to Paul's point, there's a lot of focus on the short-term risks. We see it in the World Economic Forum risk report that some of the environmental issues have kind of maybe gone down the short-term chart, whereas disruption around geopolitics and disinformation have kind of risen. But when you look at the long-term trend, it remains absolutely the same. And so board directors have this additional tension of maybe not fully understanding this very technical area, but also it kind of gets pushed into the distance as if, waiting for the sort of the future and then dealing with it then. Well, that's not how this whole agenda works. We need to be making decisions now that will support the long-term value creation. It's interesting because we've worked now with board directors across the world. We have 34 chapters around the world. It's wonderful to have some representatives in the room today across 70 countries. And the initial stage of this is that basic awareness raising of the technical aspects of sort of what board directors need to be thinking about on this agenda. But it quite quickly, it turns into understanding actually needing a peer network, needing to build the confidence in being able to not just know what the issues might be, but to how to bring them into the boardroom in a meaningful way, to be able to ask questions that are going to stimulate discussion, and also to make sure that there's that kind of recognition of the longer term value creation and the tension with the short term. And increasingly what we're seeing on top of all of these other challenges that boards are facing, we're also seeing that there's lots of trade-offs. There are some very, very difficult decisions that need to be taken in the boardroom, and certainly not everybody is going to like them. And so the kind of the confidence and the sort of inner strength, if you like, of board directors needs to be built in a way that never before. We need the leadership that can build the personal resilience alongside the business resilience. And the work that we've been doing with Deloitte and the World Economic Forum team on these new updated guiding principles is a really helpful starting place. It's a framework. It's not intended to be deep technical guidance. It's intended to be easy to read, digestible, and again, as Paul has mentioned, just to give the sense of those questions alongside the technical expertise. So if you're getting an answer back to one of these questions, then you have enough understanding of the topic and the issue to push back. So we're really excited now that they're launched to be able to move on to the next phase of work, because this is really just a starting point. It's looking into, what does this mean in different locations, in different sectors? If you're a startup organization looking to bring on a new board so that you can scale, if you're a major global organization, and how do you actually pivot in this very disruptive world? So by way of sort of introduction to the topic, what we've done is build an international network of chapters whose members are non-executive independent directors explicitly, to help them learn more about this topic and to build the peer-to-peer network that they need. And I think that local, kind of regional, global kind of dimension is really, really important, because it allows the local conversation to happen in context, but also the access to the international conversation and group in order to really understand how this plays out across the global market.
That's a fantastic way to sort of kick off the panel. And as you and I were talking before, there's just so much complexity with this, and we're trying to break it down to actionable work, and it's remarkable how that's progressing now. Anna, as you mentioned earlier, many board chairs are looking at this topic, and you were talking about how you see some boards pushing the topic to the side and some integrating it more. Can you share a little bit more about that and your conversations?
Yeah, absolutely happy to. And actually, Emily, you said it very well in that it's very nuanced depending where in the world you are focused. Are you a global business? Are you a local business? What markets are you operating in? What sectors are you in? And I think the way that one thinks about the value creation, to Paul's point, that is driven by considerations around climate and nature does depend on some of those differences. And as a consequence, once the board understands the value that is being created by focusing on this and by embedding it into strategy, as opposed to our strategy is to do X, Y, Z, that's our core selling point, and climate is something that we'll think about alongside or to the side, is how does it drive that value? And so I would say that we're all on a bit of a learning curve. And, you know, the variety of chairs that I speak to, and we often sit together and share ideas so that we can improve the effectiveness of our board. We want to add value to our organisations. We want to be that touch point that executives look forward to coming to see. And Jen's nodding, so I'm hoping that means you do when you come and join us on our global board. The executives look forward to it because they know they're going to get insightful challenge. That means we have to be well educated. That means that we have to be able to ask the right questions. It means that we have to be motivated and feel a sense of responsibility as individual board members. And as a chair, you can take a horse to water, but you can't make that water drink. So we really need to build that sense of community, connection and responsibility in our individual board members and collectively as a team. And I think when I do talk to other chairs, Jen, I think that everybody is approaching this slightly differently. And I do think that there's an element of people still needing to be convinced. I'm not sure we are where we need to be to really fully understand why focusing on climate and nature, why asking the right questions that are set out in the principles, why that's going to drive organisational value and resilience into the long term. Resilience, not just survival resilience, but resilience as in sustainable business model that drives real value for the stakeholder community. So I think boards are going to need to continue to evolve. Our traditional frameworks of sustainability committees and so on may still have real relevance, so you can get one layer beneath. But what's the full board conversation look like, and do we fully understand the value that it brings?
Thank you. You know, it's interesting because there's been this debate around do you have a side committee, and we did some work in the United States where we were looking at the evolution of this question on boards, and it is a movement more towards having it not decentralized across the board. And I'm curious if any of you have comments on that, because there's also the debate about needing it, as part of the education process, sometimes having a standalone committee to begin with. So I'm just curious your thoughts.
No, the question is what the committee does and what the board does. It's not do we have a committee or not. The board has so many things to do that you divide some of these tasks in committees. But we do that for all the governance issues. So it should not be different when we get to the governance issue that deals with the future of humanity. But then the question is, what do you do in board meetings itself? If a board has a committee that supports them and is probably more knowledgeable, actually, I would even argue, has outside resources that are outside the board that can actually advise these committees, because it's become very complex. But if the board itself has the right discussions about the risks and opportunities, because it gets to the heart of business models and value creation. You know, less than 25% of companies have adjusted their product portfolios or their capital allocations based on what is happening on climate change and nature. If you look at the latest study we just did with the World Benchmark Alliance, less than 5% now reports on biodiversity, which is bizarre. Because if you're in the food business right now, look at the price volatility you've seen on coffee and cocoa. Look at the disruptions you've seen in the value chain. Look at the risks that are there for floodings and droughts, etc. When I was running Unilever, there was this enormous drought in Brazil. It woke us up, by the way. We went ahead of the curve there either. But Brazil had an enormous drought. If you ever lived in that time in São Paulo and Rio de Janeiro, you weren't allowed to shower. The same happened in Cape Town. You weren't allowed to shower. So it woke us up, and we immediately started producing products that were using less water. We had waterless shampoos. We are still by far the market leader because we jumped into this. And that's a big market now. And it turns out that's a market is growing, regretfully. You know, we hand washing with Lifebuoy, we have half the hand washing market. You need 30 seconds of water to get decent disinfectancy. I said to R&D, we're going to have a product with 10 seconds of water. Besides, I have children and grandchildren. You don't get them to wash for 30 seconds, you know. But get the product with 10 because we just don't have water anymore. That product that doubled the growth rate of the brand because it became much more relevant for people in the market. We had toilet bowl cleaners that we couldn't ship around or we didn't have the water. Many of the toilets in the world can't flush because there's no water. So we started to look quite differently on what products like Domestos should deliver. We invented powders, etc., and looked at odors and other things as cues of hygienically clean. Those are now big brands in parts of Africa. So if you don't adjust your product portfolio to the reality of the world already, you're going to be out of business. So those discussions need to happen at the board level with the board. Then the committees can provide some expertise where expertise is needed or some deeper perspective. We had a special committee on how do you remunerate and link it to performance? How do you measure it in the culture of a company or in the activity systems? What are the key drivers? So that you want to delegate a little bit. But this broad risk thing is enormous now. And companies are exposed, but they don't want to acknowledge it. And actually many of them pay a high price already today in their results, but they just don't want to touch it because of perhaps of what you were saying, and it's a little bit the fear of not knowing. This awareness gap is, unfortunately, it's still high.
You saying about
that's what the board should talk.
Turning the risks into opportunities.
100%.
It's such an important thing, and a lot of the board directors that we've talked to have said this need to shift into long-term strategy and kind of and you know, even if you look at the top short-term risks, they've got, you know, either, you know, energy demand from AI or kind of the opportunity of AI in the context of some of these issues, the geopolitical risks, as you've already mentioned, around security, whether it's water, whether it's food. So I think there's huge opportunity.
Absolutely.
You know, the CEO, sorry to interrupt for 1 second. A CEO is very well placed to manage trade-offs. You know, we invest now in training and development for being CEO 25 years from now. I invest in building a factory. It takes 10, 15 years before I get the return on that and fill it. I go into a country like China, it might take 20 years before I make money. CEOs don't have a problem to deal with choice sets. And by the way, sometimes the choice is different. Now you have another challenge that comes on your plate, and tomorrow is, you know, AI. Well, how much do I invest? Don't invest. CEOs don't have any problem. But when it comes to the future of humanity, they all of a sudden freeze. That's the most important thing for life. What's the future of humanity, and what do I contribute to that? And they absolutely freeze in this discussion. Then all of a sudden, no, and I cannot, you know, and it goes very quickly to it's a cost versus an investment. It's a risk versus an opportunity. It becomes very bifurcated, driven by lack of knowledge. It's not driven, and you can't blame them for it because it's an ignorance that we need to help solve. You cannot put that on the person itself who is ignorant. It's very important.
Yeah, and actually quite a few conversations this week that I've had has been around the narrative over the interdependencies between business and corporate and organisational success. So we grow our businesses, we grow our economies. That's good for our economy if we grow our businesses. If the economy is healthy, that's good for our communities and our societies, and so on and so forth. So all of these interdependencies, there is a growing recognition, I think, certainly in the conversations I've had, even just this week, around we cannot just look for a mission for our business that's about creating a profit as a single measure, but actually something around what does stakeholder value mean for us, and that therefore goes to your point, Emily, about translating risks into opportunities.
Yeah.
You know, there is some encouraging news, I would say. We did a study, we've done a study for 4 years with Deloitte in and around the C-suite, 2,100 executives around the world, all industries, 27 countries. And for the first time on this topic, we've heard that 66% of them see value creation and returns to the bottom line by making investments here. So I think there is some encouraging news. Now, you talked a little bit about nuance. Emily, you did as well. You're taking it down to an industry level. Neely, you have a lot of experience in financial services. So would love to hear from you in terms of how financial organizations are looking at risk and opportunity. And that's really in and around the guiding principle number 3 here. In their investee companies and projects, including risks, opportunities, dependencies that are both direct and indirect and evolving. So would love to hear your thoughts on that.
Well, first of all, thank you for having me and for hosting this great discussion. As you mentioned, I'm an independent non-executive director of Brookfield Asset Management, which is a global manager of private capital all around the world. So when you think about private markets, it's everything from renewable power and transition to real estate, infrastructure, private equity, the whole gamut. We're headquartered in New York and managing over $1 trillion in assets under management. And thank you also for mentioning that my entire career has been spent in finance and asset management. And that background really informs how I think about this topic of managing long-term return. In finance, we have a fiduciary duty to our clients and beneficiaries also. And that fiduciary duty speaks to managing not just returns and certainly not just short-term returns, but it's long-term risk-adjusted performance. And that is also what we've been talking about here throughout this event. And so when you start to dig in on what that means, how you manage for long-term risk-adjusted performance and best practices from the perspective of finance, which invests in all the other sectors, one thing that is really important, I think, to think about is financial materiality. You shouldn't have the perspective that managing climate and nature risk and opportunity or any other risk and opportunity will be the same for every asset, sector, geography, nor time frame. And so when you dig into financial materiality, you really start to unpack what are truly the real strategic drivers of climate, of nature, of biodiversity at the asset level. And as you start to look out over time, one tool that's very valuable then is scenario planning. And I think that scenario planning is really a tool that helps boards, helps managers look into the long term in a way that's more strategic. Because you really, we use, as many do, TCFD, that's the Task Force for Climate-Related Disclosures scenario planning, which really helps you to unpack different potential versions of the world, not only in scenarios for physical risk, but also what we call transition risk. So you asked about direct and indirect risks. Some direct risks might be physical risk, like floods, drought, typhoons. But you also have risks like policies could change on us, markets could move on us because of the way that the economy is responding to these pressures in climate and nature. Consumer preferences could change. So you really think about direct and indirect risks over time across different scenarios. And as I said, for different assets in different geographies and sectors. And when you start to dig deep to this level, I think that you naturally start to see that climate and nature as a source of long-term value creation, not just risk, because it becomes a part of your way of thinking about the future of the markets, the future of the business, the future of the world, kind of as a muscle for how decisions are taken. As you've also said, which I very much appreciate as a director, one of the board's great roles is to be able to ask strategic questions. And I just wanted to take one moment to say something about how governance structures can help to help the board to focus on long-term opportunities. It's very important for us that these topics are raised regularly from meeting to meeting, both in committee as well as at the board level. And I agree with what you said, Paul. The specific purview may be different at the committee level than at the board level, but this, if everything that I just said is happening, it will permeate throughout. And the reason that it's valuable to have a regular cadence is not only so that the board is educated, but so that when the short-term matters may come up, which they will, you already have kind of a long-term thinking and discipline. You have that muscle to be able to respond to the short-term in the context of real strategy, long-term thinking, and planning.
Love that thinking. It's I think it's really good advice for boards to think about, because you're trying to balance those two things. And if you've already had the conversation around what you're doing long term, you can infuse the rest of it in the short term decisions as well. Neely, I'd love to stay with you for one more question. As the team developed the principles, they heard from many board directors that it's important to move beyond compliance. And I'm surprised we haven't even talked about compliance yet on this panel, so that's actually a positive. To see this matter as one that sits at the heart of strategy and business. So have you seen some best practices in and around this?
One of the things that I think that could be that's a very important role of the board is to help distinguish signal from noise, and really help companies stay focused on those long-term signals, those long-term secular trends. You know, I spoke about financial services. I'm talking my own book, but I find it to be a very illustrative sector, right? Because we really understand and manage market cycles. What might be a cycle, right? And what is truly long-term secular trend. And much of what's in climate and nature, I would argue almost all, is really that long-term push, right? So this is a great example of a case where the board drives thinking about long-term strategy. One of the things that I find as best practice that can be applied not only to financial services is to think about how these matters pertain and come systemically into decisions about capital allocation. And the reason I said I'm not only talking about finance is that, as you know, every sector is making CapEx decisions, long-term capital allocation decisions over time. How does the company think, this is an example of a strategic question that the board can ask, how is the company thinking about really internalizing climate and nature opportunities and risks into its cost of capital, into its hurdle rates, into its market assumptions, and taking that into account at the point of investment. And then I think it's really important, as I said, I talked about financial materiality, to mirror that in organizational design. So we really empower each asset class team to think about how these things are material to the strategy and execution of their own line of business. And as owners of other companies, empower the management of those companies to take responsibility for delivering on the ground each day, supported by a kind of overarching framework. And we have resources as well to be able to drive those opportunities in the day-to-day. So then you say to yourself, how is this structured? The investment teams take this into account in every single investment decision. The investment committees oversee and approve it. But then you also have cross-functional bodies like the Decarbonization Strategy Committee, the Operational Committee, that are cross-functional, where there's really valuable learning and education that can happen between groups and teams. One of the things that's also really valuable about focusing on financial materiality within each group is that they'll find and learn different things, and they'll come up with different solutions, and they'll find new and different ways to unlock long-term value that may be instructive to others, right? So if you think about how the whole thing builds up, then again, as I said, to the board in its oversight role.
Wonderful. I think we'll do one more question, and I'll ask each one of you, starting with Anna, to share your thoughts on this. But in this audience, we have people that sit on boards, we have people that are parts of executive teams. So if you were to think about what one thing you'd want this group to lead with, leaving this room, what would that be? What advice would you provide? And each one of your thoughts on that. Anna, with you first.
Well, I knew you were going to ask that question. I was going to answer it differently, but because of the way you've put it and because of listening to incredible...
And your microphone.
Oh, my goodness me. You would think I would have remembered it by now. It's been a long week. I'm going to say something slightly different. As you rightly said, there's a mix of people in this room. We need to work together. So boards working closely with their executives, corporate organisations working closely with the wider ecosystem actors. We need to work together. And if there's one thing that I would take away is, of course, I'd be saying, let's all keep this at the top of our agenda and make sure we understand how these considerations drive value into our organisations. But let's not do it on our own.
We've spoken a lot about climate-related and nature-related risks and opportunities today. I guess what I would really want to leave with the group is to think not just about these things as two separate things. I always consider that on the other side of every risk is an opportunity, and on the other side of every opportunity, you have to manage the risks. And so when you see it that way, you can see why today we're able really to talk about creating long-term value through both lenses. As you start to really go through your strategic thinking on these topics, even where you're finding risks, you're finding out how markets may evolve and how to build strategy, products, and new businesses into that world. So as we move forward, the idea of long-term value creation can come from both sides.
Emily.
Gosh, yeah, it's a big question. I guess maybe I would say you will have heard and spoken to so many different organisations, individuals, and I would say that take away either as a board director a question that you're really thinking, I need to understand how our business is tackling this, and think about it from an interdependency perspective rather than a siloed topic perspective, because I think that's where the real value will kind of unlock in the context of your conversation. And similarly, as you know, as an executive in the room, think about sort of how do you make sure that there's a paper going to a board that's going to be positioned in a way that's useful for them, not your own personal agenda, but what information, what way of kind of putting a suggestion to the board for conversation is a really valuable thing for them. And from a strategic perspective, I think, and obviously I'd say read the principles, but it goes without saying. But I think, you know, thinking through sort of the way to address this that's going to be meaningful for your organisation.
It's a great way to close with all of your advice. And actually that same study that I was talking about before, our C-suite study, behaviors started to change. We saw the first year that we did the study, 78% of leaders would change their behaviors once they experienced these issues themselves in their personal lives. So that starts to change things. You become more of a human. I think all of your thoughts today have been terrific. Thank you for the audience for coming in so early and staying with us through this very intense conversation. This is work that can be carried forward. On your chairs, you'll see there's a one page that you can please take with you if you're interested, or take a picture of it, which shares the framework with you and more information that you can collect from that. And thank you to our panelists today for a very spirited and great conversation. Thank you.